Hello, long time no see. So today I've decided to do a market commentary after a long time for the benefit of everyone. So this video is going to have three segments. The first segment is going to talk about trade I've taken last week and a couple of missed trades that we can learn a lesson from. The second segment is going to talk about IOFED, which is institutional order flow entry drill. And the last segment is going to talk about my overview of the market as a whole for the upcoming week. The winning trade. I was looking to enter the trade from this fair value gap and this breaker block, and then targeting the buy side liquidity. So this was the high of the day prior to creating this low. So when we create this low, this was the high of the day and we're targeting that high. And to the left hand side, there's a significant level of liquidity or something to the left hand side that we're playing off, and I will show you that in the next segment. But prior to entering this trade, we've actually incurred a loss. So the loss was when we broke down this low. We were trying to use this level of fair value gap as inversion, which means fair value gap gets filled, market breaks above it, trades down to it and uses it as support and goes higher, but it failed to break above it, and we have hit this order block and just targeting the sell side. So that was my stop loss hit. For the buys, that whole week that we took that trade, and that trade was winning. So the reason is because the previous week's Sunday open price, we were approaching it, and also we were approaching this area of order block and this area of, I think, daily open price that we were approaching at, so this gray area. And so a week prior to that trade, I was expecting market to go and fill this fair value gap or potentially trade over above the buy side liquidity on the 4 hours time frame. So it was just a matter of time of when are we going to find that entry to go long. But unfortunately, I held that trade. I mean, it was 1 to 5 with 40 with I think 10 pip stop loss, and I had like 50 pip take profit. But this move with the arrow essentially went around 150 pips. So if we held the trade up to these points, it would have been an excess of like 1 to 20 risk reward, or even more. If we held above the highs, I'd be like 1 to 30, which is absurd, and I will not be holding that long because it took around 2 days to get there. So that was the whole frame, the whole trade idea that we got from the 4 hours time frame. We were expecting it to go here and trade for the retracement. These were quite large candles down, and as we've taken out this sell side liquidity, I was expecting some sort of retracement out of that region. So that was the whole trade idea. You can see this a down close candle, which is quite clear. We come traded into, and I took the trade somewhere around here, targeting the buy side. But we didn't hold through the whole thing. We closed, I think, around here, which is not that significant. So as the market traded into that area, we were essentially breaking lows and sweeping the highs. See these highs? We're literally making relative equal highs or equal highs, sweeping them with this movement up and then dropping. So as it approached that level and did this and this, we can't be using these areas of order blocks on the lower time frames to go long, because we already swept the highs. See, we're not sweeping the lows, we're breaking the lows and sweeping highs. So that continued until here, where we took out this high and broke down lower, and then we came back up to that level, and this is seen as a break of structure because we kind of closed above this high over here. So that's the first time the market gave us signatures that it was going higher, and this is the 30-minute time frame. So therefore, when that happened on this day, which is I think Monday, and during the Asian session we've created these 3 down close candles prior to this movement, and we've created this fair value gap. And remember, we've broken this high as well, so this is a break of structure. It's not a sweep. This is the sweep right now. This is the sweep, and this is the break of structure. So that made me think, okay, maybe the market is going to stop breaking below the lows and sweeping the highs, or probably reverse and start sweeping the lows and break the highs. And this is another confirmation. You see those relative equal lows, it goes beneath it, sweeps it, then breaks the highs. See, this high was broken right there. That was the first sign, and then this is the second sign. And then I started trading during the New York session, and the trade was taken around London close. So I started looking at the market during New York session. Okay, so let's go down to the 15-minute time frame and see what's happening. So I saw this break higher, and this is where I took the L around here. So I saw this area of fair value gap get filled, and I already explained what I was looking for, the order block that is on the lower time frames. I was looking for market to trade over it and then target this buy side liquidity, because that's the area that took out that made essentially a high that broke market structure, or shift, that created a shift in market structure. So I was waiting for that to happen around here, but obviously hit the stop loss because it was digging into this area of inversion fair value gap. See this level, inversion fair value gap right there. It was trading into that, and also further into this level of order block it was trading into. But as you can see, we do not close beneath this area of fair value gap. Let me just cover that up. Cool. So as you can see, we don't close beneath this 15-minute or 30-minute fair value gap. We don't close beneath it. So that signals to you this is a sweep of this low, and the market will reverse. All the other times, these were breaks of structures. You can see from the top here, we broke, break of structure, break of structure, break of structure, sweep of the high. That is a sweep. And this is a break. So the low is broken. But instead of breaking the lows, it closed inside the fair value gap and inside the low. See, it doesn't close beneath the low, and it doesn't close beneath the fair value gap, which means this is a manipulation just to tag into this fair value gap that's inverted and then potentially go higher. So let's delete everything because I think it's looking quite messy out here. Okay, so let's turn on the thing again. So this is the 5-minute. The sweep I was talking about is here. Trades above, trades below. I didn't wait for this break of structure because I knew this was a sweep and I just traded off this fair value gap right here. I just traded when this candle opened and traded up. But if you're conservative, you could have waited until it traded into this level of fair value gap, shaded blue, and this area of breaker block that is shaded grey. So this is a breaker block because look what it does. It goes higher, sweeps the highs. You see, this is where I got tripped up. I got the loss here because it didn't close above. See, that was a sweep. I failed to identify that sweep. That's why I got the loss. So if it swept above the highs and then it dropped, sweeping the lows, and then we broke above it. So this is your essentially the breaker structure. When we pass that candle right there, that's your breaker structure. If you are trading with the fib, you could just pull the fib from here up to the high, and you could be placing your trade below the 50%, because the 50% and below is discount, above is premium. So when the market stops there, you're not going to be buying from this area of fair value gap right here. You know the reason being because this area of fair value gap that is shaded red is in the premium side of the curve, and when you're premium, you're selling. You're not meant to buy PD arrays that are formed on the premium side of the swing projection from the low to the high. You're not supposed to buy from here. So you found this other fair value gap that is on the discount side of the PD of the curve, and you could buy it from there. Don't worry if you don't understand this segment of the section of the video. You could just message me on Discord and ask me to elaborate on the part that you don't understand. Okay, so it traded above that level. At this time, I literally just moved my stop loss to here because I knew when it traded onto this fair value gap, I knew it would not. It would leave this area. It would use this area as IOFED, which we will cover in the next segment. It will leave this area as fair value gap, this segment, and it will go above it. So I'll put my stop loss there. If we would want to come back, it would have used this area of fair value gap or this area of fair value gap to then propel price to go higher. So I put my stop loss there. It doesn't need to be down here anymore because this is your manipulation leg that took out the liquidity from here, took out the liquidity, drove back up, broke outside of here, and this is your area of breaker. So market shouldn't ideally come back down and break this low. If it does that, your whole idea is wrong then. So for targeting purposes, I use relative equal highs. So if the market creates relative equal highs on this leg of price when it's coming back down, I use that as the first targets. So you can see the high over here and the high over there create relative equal highs. So that made me that reassured me that the market will create will go above that level at some point. And also I use trendline liquidity at times, which is, the whole morning we were trading like this. We were trading like this, down, 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 respecting this level. Multiple times we broke above it. Right there. This gives, and when it comes back down, it gives hope for these people that it will probably go lower. But it doesn't, it goes higher. Okay, let's explore the reason I was expecting the market to stop here and potentially not go below here and start reversing from there. So one reason is the daily open price of this day, which is the Tuesday that I took the trade, was around here. I'll just highlight that. So as we trade beneath the rule of thumb is, as you trade beneath the daily open price, we are in an area of discount. So you'll be looking for buyers if your bias from other things is buying. So you should be buying beneath the daily open price. And also the 8:30 open price. I think 8:30 open price is around somewhere here. See that line? So if the market is below the daily open price, which is here, which is this whole part, and is also beneath the 8:30 open price, it means it's in really discount zone when you want to buy. So when your bias is buying for the day, and you see these two things, and the market is beneath that still, that means the market is in a really good discount. So I literally just bought off the retracement down to that daily open price. You see the daily open price. Oh, sorry, the 8:30 open price. I literally just waited for the market to come down there, used it as support, and then trade over it. Because I knew all of these were relative equal lows. Everything was relative equal lows, along with the daily open price. As market trades beneath it, this whole thing from here down is your Judas swing for the day. See how all of that makes you think of buying this, because everything adds up together. It makes you think we're below this relative equal lows, and we're below this level, and we are in a Judas swing. So then we will probably respect this level because we've taken out liquidity over here and use this as an, I don't even look at it as order block. I honestly just look at it as area of manipulation, and I look at that session open price, so which is here. Look at this. Look at the session open price, the 8 p.m. open price. See how precise that is. You can just use that session open price if you don't want it for the market to manipulate it, and that will act as your order block. Literally, you don't even have to find area of down close candle on these low time frames. You can just find the session open times. But that is only applicable to Asian, and is only applicable to New York and the 8:30. I don't really use it for London close or London open. I just use it for the Asian. So if I don't want the market to trade beneath it, I use that as order block. And look how nice that touched that level, rejected, broke structure, came back to that fair value gap, and then propelled price upwards. Yeah, this segment is quite detailed, so I'll probably have to make another lesson on this section and what I'm talking about. Okay, so once market went above the London Open kill zone highs, it traded close to extra 40 pips above that level, and this was the previous day's highs. It went above that right here, and it went above the Friday open price, which is right there, and it retraced lower. And then the next day traded up and up and up and up. So the only shortcoming with this trade was the fact that I didn't consider going above the previous day's high, and also the Friday highs. I think I could have capped a good trade if I held it till it took out those highs. See, it takes out that high, and what lays above here, buy side liquidity, tags it, and that's around 4 p.m. so the end of the day, and then it drops back down. because it took out this liquidity. So you could have had a quick short opportunity from this level down to this fair value gap, and you could have capped 26 pips short scalp. I'll be using examples from trades that I've not executed on my live account, that I've essentially executed on the demo account because of the volatility of price that was during that time. Okay, so the first trade is going to be buys after I closed this trade. So it took, I think, a day, and it was the next day. So we were targeting the buy side liquidity that rest above the Asian highs and the previous days, the previous week's high, I think. And the arrow I showed in the beginning of the video, where I said it's gonna go from here up to there, it basically demonstrated to us that if we take this buy side liquidity, market would do some type of Judas swing above that high, and it will have to go above that high to then do the Judas swing. So we're targeting that high first. The sells, I didn't really catch them because I was not on the chart at that time, but I really took the buys from here, and I will show you video evidence of that, and I will explain what was happening and what I saw in the chart during that time. So this is the video. I'm gonna play it. Okay, I think it's quite fast. I'll pause in each section. Okay, so for this day we have this low that was created, relative equal lows, but still we were expecting the market to target the highs, these relative equal highs. And for that day we had FOMC, which meant price would be extremely volatile. So when FOMC numbers got released, we've actually dropped down, taking out this buy side, this sell side liquidity from the previous days. I believe the New York session, 9 a.m. is the New York session, and we've tapped into the liquidity, or the area of fair value gap that rests below the London Open kill zone lows. So this is my point of interest. This is my PD array around here, and we've tapped into that with volatility and with tenacity. So you can see how this candle opens, this bearish candle opens, drops. I'll just zoom in. Opens, drops, closes here, and then that bullish candle opens, drops, and then rallies higher. And prior to this happening, market was literally just taking out or sweeping the highs and breaking down the lows. So this whole segment from this relative equal high that was created towards New York close, this was whole bearish. But the fact that we took out this liquidity down here, tapped into that, broke higher, filling this FEG. This FEG is very important because it's taken out this low. You see, market took out that low and create this FEG, and we've closed above the FEG. We're trading down to this level. So let's continue this. Okay, so this is the 5 minute. It essentially shows the same thing. These two down close candles can be called bullish order block. I have these other levels drawn in case it uses this as liquidity and does go up from there. But in this case scenario, we didn't need to go down here because the liquidity was already taken down from there, and we were trading into the wick. And remember, we get the fib for the wick. We get the fib, and we use the 50% of the wick as a PD array, just like an order block on the seconds time frame. Okay, let's continue. see this level, that's your order block that took market down into that wick. And as you can see, we're not closing beneath this level into the FEG and the order block. We're not closing it, we're wicking it, and we're wicked below that, those two candlestick wicks. See, we wicked beneath it and exploded up, wicking that level 2 with the order block inside it and that little FEG. So that shows you we've taken out both sides of the market. We've taken out the sell side with the lows, tapping into that, and also we tapped into the order block. So you want to see if the market is going to use that as inversion. So whenever order blocks fail, we use them as inversion and they become breaker blocks. So I wanted to see if this becomes a breaker block so I can go higher and target these high, high, and high, and all of these are relative equal highs. Boom, right there. You break above it. And it comes back down into there. Hold on, I think it went too fast. Okay, so you see I'm placing the position tool there. I'm placing the demo trade as well. And I'm having that 10 pip stop loss below the wicks I was mentioning to you that took out the sell side liquidity, took out the liquidity that drove up. I put my stop loss there and I was entering the trade from here. And also look at all of these highs and where it's retracing down from. If you get the fit from here to there, this is precisely the 50%, and this is where your breaker is formed. So this high, this high, this high, this high, they're all relative equal highs. People are getting their support resistance, they're drawing their lines, and they're saying, oh, the market went down here. Okay, it went down here, I need to go down. So the market is going to punish them. These are all relative equal highs. And when this relative equal highs gets taken and hits our objective target, which is the high, then we're going to have that Judas swing on the high daily time frame that I was mentioning you just a while ago. And that will have the big drop. So then we'll just skip this part. You see I'm drawing the arrow. So it accelerates up quite fast. And I think the rest of the video I cut it off because of time restraints, because it was taking too long. So I had this area in mind of fair value gap, and remember that area of thing that took out the sell side liquidity, or that took out the manipulated the lows. This area where we traded above it and created a FEG breaking structure, remember, that becomes your area of breaker. And in the future it comes down slightly lower during the night and then goes to the higher targets. Yeah, I kept the video over here. So right there, you see the breaker I was mentioning to you, right there, stops right there, goes higher, goes to targets. In this time frame, it might close beneath this, but on higher time frame, I believe it wicked it and it didn't close inside the breaker. Wait, I think the one now. Yep, exactly. So the breaker you can see is right here, that wick. We wick it on the 4 hours. We wick it, don't close beneath it, and then drive higher. So that's for that hypothetical trade. Would have literally been the exact same trade as this one with the buys. Been nearly 1 to 5, but I didn't take it because of volatile period of the market. There was volatility in the market, and you see we took out this sell side down with these 3 consecutive, and look what happens here. Take out liquidity, drive down into that bullish, into that bearish order block, those 3 consecutive non-close candles that broke structure, right there, come back down the next day, drive higher. Okay. All right, let's go down to the IOFED. So what is that? So that's when we expect areas in the market, more precisely the fair value gaps, not to be filled completely. So this is one example. You can see we broke beneath, we hit some level of high time frame PD array, we exploded up and up, and all you need for these type of entries is the market to trade into the, because how you form a fair value gap is three candles. So this is the first candle, the middle candle, and the third candle, and the gap in between forms your fair value gap. So all you need is the low of that candle to be breached by a little pipette, or even just breached like that, and you enter the trade. But obviously your stop loss in this case can be 7 pips, can be a little bit more forgiving if you put it beneath the lows. If you put it up here, that would be ridiculous. Like that would be 2 pips or 1 pip, and that's not really practical. So you could have put your stop loss down here, and when it goes here, you take the trade. And the only reason that happened is because we created a lot of relative equal highs, and we were dropping hard during the day, and the market needed some sort of retracement up to the fair value gap, right there. And I pointed this fair value gap on the Discord as well. I pointed that level, 1.2877, and I couldn't really take the trade because it was outside the trading period. So these type of IOFEDs only occur when the market is in a hurry. When it wants to take these liquidities out, or when it's been dropping quite hard and is in a hurry, you can take these IOFEDs. So these 3 consecutive candles, wick, they didn't even break any structure on the 1 minute. So they're quite risky if you take IOFEDs. It could just come here, keep dropping. That's why you have to be mindful of the higher time frame objectives. Does it want to accelerate there because there's imminent areas of relative equal high that it needs to go above and rebalance, or it needs to go above and rebalance this level of fair value gap? So there needs to be a level of urgency for you to take the IOFED entry. These don't often occur during, say, we take our sell side and we break structure. They don't happen then. They happen after we break structure and we trade above and we're around here. Then is when the IOFED takes place. But in this case, it's quite exceptional because it happened so early. Even before when the market broke structure, it happened. So this is a rare circumstance. But even if you just had this relative equal highs in mind, you see this high and this high, they're relative. This high, this side, this side, they're all relative. And there is an urgency in price. So you see the urgency of the price trading up. And we didn't close beneath here, meaning we are breaking the low. We are sweeping the lows. And now we need to break the highs. So you could just take this entry, put a 7 pip stop loss, and aim for above the relative equal highs, or more precisely this fair value gap right there, where the price just went lower for the day. Fortunately, I wasn't able to trade for this day because I already reached my target during the start of the week. I will post more content on IOFEDs, and for me personally, is not in my repertoire of it's not in my concepts, it's not in my model. So when I'm looking to enter a trade, I look for certain things, but I don't look for IOFEDs. It happened in this circumstance and I saw it coming, but it wasn't, and also we were outside a period of news. So I could have literally just taken this on a live account, but this is not in my model, so I didn't take it. I saw it. I knew it was gonna happen. I knew we were going to trade into this FEG right here. And I could just taking the trade when it was reaching here, put the stop loss beneath the lows here, but I couldn't because I didn't see any breaks of structures.